Okay, in this tutorial, I'll be going through with you NEOG symbol, and I'll just copy that, paste that in Google, and write stock besides it. And I can see the name of it, and I can see it's a food safety company, and the market cap is in billions, which means it's a big size company, and dividend yield is nothing. So if a company has a dividend yield, that means that they have extra money to give away to the shareholders, and after paying their costs, their loans, their liabilities, and everything, they still have money left, and they pay to their shareholders, which means they're financially very strong. If a company don't pay dividend yield, it could be they don't have extra money left after paying their loans, creditors, and liabilities, and so they're not financially very strong that they have money left at the end, or maybe they have money left at the end but they are investing back in their company. So there are two ways out, because there are many big firms that have a lot of money left at the end of the day, but they choose to invest back in their firm to further grow. So it's up to them to decide, but this is one factor to consider. Then you can see it's founded in 1982, or you can just click in Wikipedia and you can see this box, which is very helpful, and it says founded in 1982. And then I'll just show you one thing. If I want to buy the stock right now, I can just see from Google it's 64.78 US dollars per stock for one stock. And I'll just copy this exactly the name, and I will see Indeed and reviews, and I want to see what reviews, what employees who are working there think about it. There are 50 reviews in total, which is not a lot of reviews, but still, and it's 3 star, which means it's above, it's like average, I would say. But you can just go through yourself, read through the reviews. I'll go to Glassdoor now, and let's see. It has 142 reviews, which is a lot more than Indeed, and it's 2.8 star. So you can just go through yourself everything, and so that's it. And then I want to show you Justia Patents, which is a website for patents, and I want to see if it has any patents. And yeah, in 2017 it has a patent. So I'm not looking at inventors, I'm just looking at assignee or applicant, because these are people who have full rights of the patent. Inventors are people who invented that, but they don't have the full rights. So I'm interested only on assignee and applicant. 2017 they have a patent, 1997 they have, 1985, 1996, 2011, 1996, and so on. And you can just go through it yourself, the whole list, and make sure it has recent patents 2016, because the more recent it has, it means it's still innovating, it's still thriving, it's still competitive, and it's doing very good. 2017, 2018, and so it means it's still doing really good, working really hard to innovate, to be different than its competitors. The more patents a company has, the stronger it is, the stronger moat it has. And I want to go to Yahoo Finance, and I will just search that inside, and I'll go to profile, and you can see the sector is healthcare, industry is diagnostic and research. You can see the employees, you can see 5 executives, and you can see that there are 4 employees with salaries shown, one is not shown, which means that one salary is not shown. You can search this somewhere else, why it's not applicable. The more information we have, the more better, the more trustable it is. So you can just search, maybe somewhere else it's written why it's not applicable. And now lastly, I want to go and show you macro trend, which is brilliant website for ratios. Click price ratio and price book ratio and just paste in this symbol, and make sure you click the right one. And this website has a lot of data, so it might take, you need to be patient with it, because it has a lot of data, it takes time to load. So just be patient with it, but it's a brilliant website to find out ratios. So you don't have to calculate yourself, you don't need to know the formulas, don't need to be good at maths. So even I don't know the formulas, I can't do it on my own. So it's very handy, but you just need to be able to wait for a while, and then it's okay. And please ask as many questions as you want. because that helps us learn more. So please let me know if you have any questions regarding anything, or if I'm just going very fast and you want me to slow down. So, just tell me. So, book value is the real worth of the share, and stock price is the market price. Price to book ratio, that is, I'll explain you briefly. Price to book ratio, if it's less than 1, that means the stock is at discount. It's cheap to buy, it's undervalued, you're getting it at discount. If it's less than 1, it's ideal time to buy. You're buying a cheap stock. If it's 1, that means that it's same price at market price. You're buying for exactly the same worth, and it's not expensive. If it's more than 1, then that means that it's expensive. The higher the number goes, the more expensive it gets. Right now, it's 5.44, which means it's five and a half times more expensive to buy this stock right now. In 2018, it's eight and a half times more expensive to buy the stock. So if you just go vertically up, you can see somebody who bought that time in 2018 August, they bought it for $93. They bought $93 to buy something that was only $11 worth. So they bought it very expensive. They spent a lot of money to buy something that was very, very low in price. And if you see, uh, for example, 2006, it was 2.1 times more expensive. And if you see vertically up, somebody who bought in 2006 August, they spent $4.22 to buy something that was $2 worth. So they bought it like twice more expensive, but you know, in 2018 August, it's eight times more expensive. And right now it's five and a half times more expensive to buy the stock. So you need to be careful, even though the stock is doing brilliant, but you need to be careful if you're spending a lot of money, or if you're buying it very expensive. That's very important, because obviously, you know so let's go to other ratios now. Current ratio, if it's less than 1, that means the stock is very risky, it's dangerous. If it's 1.5 or more than that, that means the stock is very safe, it has good margin of safety. So look for ratio 1.5 or more than that. So I'm looking for 1.5 or more than that. It's 12.33. It's a lot more than 1.5. So it's quite safe. It's very safe stock to buy right now. It's not risky. Let's see the previous trends. We want to make sure it doesn't go below 1.5. Let's see. Okay. So we have data since 2005 up till now. It's like 14 years. Since 14 years, consistently it has been above 1.5. So it has been since 14 years. It's very safe. So that's brilliant. Let's go to debt equity ratio. We are looking for zero point 0.5 or less than that. So debt equity ratio, we have the data we have. The debt, it took debt in 2005 and 6. So it's always been less than zero point 0.5, which is brilliant. And so it means it's very safe. And it hasn't taken any debt since 2006 up till now. So that's brilliant. It means it's a very safe stock. It's very good margin of safety. Let's see return on equity. We are looking for 8% or more than that to be brilliant and ideal. Now let's have a look. So we're looking at 8% or more than. Let's look, it is more than 8%. And let's look at the previous trend as well, that we want to see if it ever gets below 8%. No. Since 2005 up till now, it's always above 8%, and that's brilliant. It's a good consistency since like many years. So it's brilliant.